Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining us on what will be a brief video discussing the risk-based capital ratio. Specifically, this research note from which this video is drawn was published in our August 2023 Assured briefing. The focus is predominantly on writers of private passenger auto. It occurred to us midway through 2023, now a year and a half into very difficult underwriting conditions, high loss ratios, and bouts of adverse reserve development experienced by a lot of auto insurance writers, that those could coalesce to drive risk-based capital ratios lower. We decided to look into it, and indeed, risk-based capital ratios for most auto insurance writers are lower at year-end 2022 than they have been in some time, in some cases in a decade. But with that, why don't you just bear with me for a sec? I'll share my screen and we'll get right into it. Good. So the name of our research note was risk-based capital ratios may begin to bite for auto insurers. RBC metrics were put in place 30 years ago, in the early 1990s, and it's been our observation that they really, in the main, haven't been a meaningful business constraint for most insurers, particularly for diverse insurers that are well diversified by product, and of course, if they're reasonably well capitalized, that's a good combination. RBC metrics typically not a governing constraint for insurers. But with auto insurance experiencing kind of generational levels of unprofitability, high loss ratios, adverse reserve development since the call it in air quotes the end of the pandemic, but in 2022, with the onset of inflation, supply chain issues, return to normal driving behaviors or worse in many cases. It's been a tough time for auto insurers, some regulatory challenges with getting rates approved. So you put all that together, and it occurred to us that risk-based capital ratios might be lower. And in fact, when we looked at the top 100 auto writers for the year 2022, fully 24%, so call it a quarter of them, of the individual entities writing auto insurance were produced at year-end 2022 the lowest RBC ratio that they'd seen over the preceding 10 years. And this isn't just the smallest among the top 100, the smallest companies. Among those companies, eight of those were among the top 10 were subsidiaries of the top 10 auto writers, or belong to the groups of the top 10 auto writers. And what we're going to focus on, much of the remarks here will be on just mentally rolling forward the year-end 22 results to year-end 2023. And we think you'll, in the end, agree with us that the results could be worse still in 2023. So here's what the RBC drivers look like for a typical auto predominating insurance company. About 70%, and across most companies, let's call it 2/3 to 70% of the risk-based capital need is driven by underwriting risk, shown in red, and premium risk, shown in blue. We don't have to get into the details of the RBC formula. It's not hard to understand, and it's intuitive that adverse development is bad. If you have it, it drives risk-based capital need higher, both in the current year that you experience it and in all likelihood in subsequent years for a period of time anyway. So adverse reserve development bad, that's in the red. In the blue, higher loss ratios typically translate into higher higher risk-based capital need. Higher loss ratios are an expense ratio is added to that, and to the extent that you're producing a potential underwriting loss, you've got to hold capital to potentially plug that account for that loss. Again, we'll go into the details beyond that. One last bit, though, as soon as I say that, product diversification is good. And of course, then the opposite is true. The less product diversification a company has, typically then the higher the risk-based capital need. So the focus here would be on auto insurance companies, and then particularly auto insurers that write predominantly auto and are not well diversified. Um, but what we do need to just understand, again, very easy, is that both the underwriting risk and the premium risk, there's a 10-year averaging process, where the individual company's 10-year average loss ratios by line of business, and then their reserve development experience across the preceding 10 years. And when you, so those factor into the formula. Again, higher is bad, drives higher capital charges. But if you want to mentally roll forward from year end 2022 to year end 2023, it's really fairly simple, because you just have to think about, okay, what's the difference between the loss experience, favorable or adverse development, or loss ratio coming in calendar year 23 versus what's being taken out or rolling off. In this case, 10 years ago will be next year, the 2013 calendar year experience will be rolling off. And when you do that, and think about the dynamics of the loss ratios as they are today across both pricing and reserving risk, what I'd say is that bad guys are rolling into the formula, and good guys from 2013 are rolling off and out of the formula. So therefore, the risk-based capital ratios seem likely to rise, and risk-based need seems likely to rise. Risk-based capital ratios likely to fall. Think about auto physical damage. That's the top bar. Over 90% of the companies, the top 100 here, had a 2022 auto physical damage loss ratio higher than the 2013. Now, what's going to come in is not 2022, but 2023. But the average difference was 19 loss ratio points. So although one might argue that the 2023 loss ratio should be lower than 2022. Oh, by the way, the first quarter and half of the year doesn't look particularly favorable. But let's say there's going to be some improvement, but it's highly unlikely to be 19 points of improvement. So almost certainly the 2023 loss ratio coming in is going to be higher than the 2013 loss ratio going out. More risk, more capital. Same is true in auto liability. There, about 70-ish% of companies saw their 22 loss ratio higher than 2013. That was by an average of 12 points. There again, you might see some improvement. Seems unlikely to be 12 points. In the main, you got a higher loss ratio coming in 2013 as compared to what's rolling off in higher coming in 2023, higher rolling off in 2013, excuse me. So again, more risk, more capital need, lower ratios. Adverse development, that's the bottom bar. A little bit more straightforward. You got about 2/3 of the companies in 2022, this top 100, experienced adverse reserve development through mid-year. We haven't taken the score yet, but certainly lots of companies have reported adverse reserve development and will. 2013, it's not shown here, was generally a favorable year for private passenger auto reserve development. In the main, across the industry, it developed favorably. Again, it seems like you've got a bad guy coming in with potentially meaningful amounts of adverse development, and a good guy rolling off in 2013. So what's that mean? It means risk-based capital ratios, which are already, as we noted here, across the top 100 individual writers of private passenger auto, 24 companies, and therefore 24%, were reporting their lowest RBC ratio across the last 10 years at year-end 2022. This shows the median ratio and how it's progressed. The good news is when you look at 2022, there's still plenty of cushion there before either the red line or the black line companies get to the point where they have to start having a conversation with their regulators. But certainly regulators look at trends the same way we would, and nobody likes to see a trend that falls from left to right. Pardon me, unless it's an expense ratio. So, and certainly in terms of RBC ratios and capital adequacy, you want to see a rising trend or at least a stable trend. Certainly not what you see here, where risk-based capital ratios at year-end 2022 across these companies have been halved compared to where they were a decade ago. And again, I'll just point out this includes some individual writers that are part of the top 15 private passenger auto groups. These aren't just this problem is again isn't relegated to the less well-known and smaller and less diversified insurance companies. So what can be done? Well, the first thing, of course, is focus on the fundamentals. Uh, Pricing, underwriting actions to improve the underlying loss ratios and auto liability and physical damage. Um, Obviously, companies are working hard at that and interacting with regulators to get that done as expeditiously as possible. Mitigating adverse development makes a big difference. So people will want to I'm sure actuaries it's not lost on actuaries, but it's worth remembering that there really is a lasting penalty if a company experiences adverse development. Um, uh, Financial professionals, if they haven't, and many probably will have already started to engage in financial modeling and pro forma financial analysis. But if you haven't, it might be time to start thinking about that for year-end 2023. The results for the year are at this point at least partially baked, but there still might be actions that could be taken. If you don't have a risk-based capital pro forma RBC model, the model that S&P Global makes available is we found to be very useful. Financial professionals will, of course, this is bread and butter, a bread and butter comment for them, but they'll want to think carefully about cash needs at holding companies and dividend paying capacity, especially under different scenarios across their fleet of underlying insurance companies to the extent that they have multiple insurers. It occurs to us to share that the equity market recovery, if it lasts through year end, it certainly will help because equities are carried at market value in the statutory financials. So that's one bit of relief. Changes to reinsurance could be on the table for companies that are perhaps either are presently or are forecasted to get uncomfortably close to kind of a danger zone or a level that regulators would start to raise their eyebrows. Certain types of transactions could temper the underwriting risk charges. And it's worth remembering, too, that we're focusing on auto insurance. Lots of companies that write auto also write home, which means cat risk. And Murphy's Law says that cat risk or catastrophes, if they're going to strike, probably will strike at the least opportune time. That could come when RBC ratios are already low because of private passenger auto pressures. So remember catastrophe risk and think about cat tolerance in the through the lens of how it could impact a cat could impact your RBC ratios. So we are not advisors. I think most of you who are listening already knew that, and you perhaps have already thought about other ways to address this or analyses you might want to undertake. Our main goal was really just to flag the likely adverse direction of RBC ratios in 2023 from the difficult times being experienced now by auto insurers, on top of or following year-end 22 ratios that across a lot of companies were already either at their lowest point in 10 years or at least lower than they had been on average over the last several years. So we hope you found this useful. And it encourages you to read the research note. We're going to do more on this in the months ahead. And if you're seeing this and aren't a subscriber, reach out to us and we'll be happy to get you our August briefing as part of a trial to our work. So thanks so much for paying